Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. The sell off in global bonds, which was a story we discussed yesterday, seems to have continued, with the bond market showing further signs of a flare up. The sell off in bonds or the rising yields are now reaching key inflection points. The 10-year US benchmark reaching 4.73%, while the 30-year yields are almost at 5% now. It wasn't limited to the US. Bonds in the EU and the UK are experiencing consistent sell off as well. Just to give you a perspective, the European 10-year yield is up 50 basis points since the start of December, while the UK 10-year is up 60 basis points since the same time. Good morning, JK. How are you reading these moves in the bond markets? They seem to be concerning. And is the dollar remaining well bid because of these factors?
Good morning, Swaraj. I think bond market just got saved the day from a further turmoil yesterday, but it did start on a very sour note. We had rises in yields across the regions. UK 10-year was up 12 bps in a single day. Then Japanese yield rose to 1.18%. That's the highest since June 2011. US 10-year rose about 5 basis points to 4.72%. That's the highest since April 2024. And similarly, German yields. It looked as though the 30-year will also reach the 5% mark. But then, what the two factors actually saved the day, at least for the time being, because we had a very good option on the 30-year paper because as the yield was nearing 5%, the long-term investors were lured into that kind of a yield, and at least that auction went well. In fact, auction was concluded at 4.92%, which was good because market was already tending towards a 4.95%. That was one thing. And there was also a statement, from one of the Fed members, Mr. Waller, who said that if, as expected, if the tariff do not have a significant or persistent effect on inflation, they are likely to affect his view on the interest rates, and he believes that more cuts will be appropriate. So that these two factors actually, help the market to, cool off in the bonds, and the yields came down a bit and settled at slightly lower level on the day. Of course, the economic data was not really supportive of bond market because the private sector job creation was still good, although it came at 122,000 versus 146,000 in November. At the same time, the jobless claims came at 11th month low of 201,000. That was well below 215,000 that the market was expecting. Although again the outstanding employment claims rose by 33,000. I mean the continuing claims. So the job market was kind of mixed, I would say, but that could also be another factor for the yields to be slightly moderated in the market. And then, of course, we also had, for the dollar, this was a big support. We saw the dollars rise from 108 towards 109 once again, because the yields were going up, and then the data during the day from Germany was very weak. We had industrial orders which slumped to negative territory once again on the month, coming at 0.4% negative. And then we also had the retail sales that was again once again coming very weak. So the weakness of the Eurozone economy was reiterated. At the same time, we have seen a lot of data from US once again confirming the US economic strength. So these two factors, along with the yield rising, actually supported the dollar. Euro, which had actually touched 1.0440 after the Washington Post story a couple of days back, which was later denied by Trump, slipped below 1.03 once again, and we had a slump in the UK pound as well, dollar yen rising above 118, the Chinese one at 7.35 once again, all pushed up by yields in the US. There's no relief for these currencies. Now we are now heading towards the US job data tomorrow, which is expected to be in excess of 150,000, and unemployment rate expected to remain at 4.2%. Today we will not have much of a data because US market is working only half a day, paying respects to the former President Mr. Jimmy Carter, and then it will be a slightly lighter day on the data, but market will be keeping a very eye on the bond market once again, at least in the European session, because one factor that we should keep note of is the move index, which is which index actually that shows the volatility in the bond market that has been seen rising after we bottoming out in mid-December, and a move index actually movement in the move index actually also impacts the stock market. So far we haven't seen much of an impact, but definitely if it starts moving up further, that can actually impact the stock market as well. So maybe some sort of a calmness today in the market ahead of key data tomorrow, and then we will take it forward. But overall, with no clear plans, which even Yellen was saying yesterday, there is no much scope for cutting down expenditure, for reducing the deficit, other than maybe some part of the defense area. I don't know how the yields can be kept down much, because the deficit keep increasing and the debt keeps increasing. There will be time for when this will become a big headwind for the markets, and we'll have to see what kind of policy measure that Treasury Fed yields headwind for the economy. As of now, I think it's a waiting game. Rupee, of course, hit a new all-time high yesterday, above 85.85, applauded by the dollar index, which above 109. Good demand that resurfaced after a small dip that we saw a couple of days back, and then even though the government came out and said that they're bringing down the trade deficit by about $5 billion due to an error in calculation of gold imports. But that was already in the knowledge of the market, and therefore that did not really impact. It's all about more and more expert voices also being heard that the rupee should be allowed to weaken further, considering the various external macros of the country. So that sentiment is kept quite weak, and therefore the demand resurfacing once again, keeping the dollar rupee well bid. And as of now, it does look like 86 is not far off for the market, and unless we see a strong reversal in the dollar index or in the Chinese one, and I think that is not in the horizon right now, not at least till we see some very big statement on the dollar from the Trump administration, this trend is likely to continue. Of course, the pace at which we will go will obviously depend upon how the RBI approaches the market. Thank you.
Thank you, Jackie. And just quickly summarizing, markets will be keeping an eye on the bond markets, which are showing increased signs of volatility. On the data front, we had jobless claims yesterday at 11-month low of 211,000, but continuing claims from the US rose, indicated somewhat of a mixed picture, which further contributed to some cool off in the yields. So the yields were also saved by the solid auction on the 30-year paper, There was a good demand on that as investors lapped up the opportunity to get 5%, closer to 5% yield. So long-term investors were definitely buying those papers. Data from Germany on the industrial orders slumped to the negative, and retail sales was also very weak. So this weakness in EU economy, it has reinforced markets' worries on the economy and triggered a sell-off in the euro. Broadly, all currencies were weaker against the dollar, even Chinese yuan trading at 7.35 against the USD. Tomorrow's non-farm payroll and unemployment rate from the US will be in focus for rupee. The strength in the dollar index did not spare the rupee as well. There was weakness hitting all-time lows and good dollar demand pushing the rupee consistently towards its lows. That's it from us today. Thank you for listening. Tune in tomorrow for the latest in the financial markets.